The following program paid for by Lifespan Wealth Management. Providing financial advice since 1993. It's time for Your Money with Sherry Goss, Randy Goss, and Jonathan Eisner. And now from the Macon studios of News Talk 940 WMAC, it's Your Money.
Good morning, Middle Georgia, and thanks for tuning in to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. So if you're looking for an investment advisor, call our office at 478-922-8100 to set up your complimentary consultation.
Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience and has been serving Middle Georgia for over 30 years. You can learn more about our services by visiting our website at retirerelax.com. And while you're on our site, go to the special reports section where you'll find several reports that are available to you for free. You can also sign up to receive our digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money.
We also offer seminars to the community at no cost. So if you're in need of a guest speaker for your church or civic organization, give us a call, and together we can decide what topics you would like us to present to your group. Again, our contact number is 478-922-8100. Good morning, everybody, and welcome back to Your Money, and it's great to be back with you. And we're going to jump right into the markets. So if you study the markets like we do, you may have noticed a graph that looks akin to the Grand Canyon starting on February 19th, which we're going to call the left cliff wall, all the way until April 8th, which looks like where the Colorado River would run, and then upward to today, which we're going to call the right cliff at the top. While the right cliff wall is not as high as the left, it is still a lot higher than the riverbed. On February 19th, the S&P 500 peaked at 6,117, and that's the left wall. And just 34 days later, the market closed at 4,982. And as of last week, while not all the way back to the February 19th high, it's not far from it. And all of this period happened in just 3 months, and that's been a very volatile time. But the question is, are we out of the woods? So let's go over some data points. First, the mega cap stocks have been seeing a rally, and AI enthusiasts are plowing money into the markets. However, the 800-pound gorilla in the room is still the ugly T word, tariffs. While temperatures have cooled, we must remember that we are right now in the middle of a pause or a cooling period, and hopefully there are some serious negotiations going on behind the scenes because there are a lot of outcomes still up in the air.
Even with the pause on most reciprocal tariffs, the deal with the UK, and a temporary decrease in the significant duties in China, the average tariff rate still remains well above that seen over the last several decades. And anything announced tariff-related seems to move the market. Like yesterday morning when Trump threatened to put a 50% tariff on the EU. You guys probably saw that.
Yep.
And now a 25% tariff on Apple phones if they're not made inside the United States.
So yeah, anything tariff-related announcement pretty much jolts things. But at this point, it's unclear what the long-term effects on the stock market, economy, and inflation are going to actually be. But there are some promising points to be made. There seems to be some improvements in macroeconomic data, and to put it simply, some areas simply refuse to break. The services sector, for example, remains very strong. If the unemployment rate continues to stay at or below the current level, it would mean the job market and the broader market are holding up, at least for now.
Another area we should be on the outlook for is trouble in the housing market. There's been a spike in home cancellations and stubbornly high mortgage rates. This week, the 30-year rate hit 7% again, and home builder confidence plummeted. In May, with the National Association of Home Builders Housing Market Index falling sharply. Right, home builders are struggling with broad concerns that include high interest rates, tariffs, building material cost uncertainty, and a poor economic outlook. And to revive demand, they have been forced to offer significant incentives and price cuts.
Yeah, I wouldn't want to be a home builder right now.
No.
But as a consumer, right now it's best to pay off debt and put money into that emergency savings account that you hear us talk about on this show so often. It is important to be prepared for the unknown, and right now there remains a lot of unknowns. You know, we are optimistic, but we are also realists and understand that we don't know which way the winds are going to blow with so many political initiatives still in limbo. So, all right. Last week we had a lot of requests for via email for the wills and advance directives from the Emory Law School. So if you search Emory Law School, just Google it, This data comes up under the legal resources for the COVID-19 crisis. And if you can't find it, email me, randy@rfmoney.com, and I will send you the link. And regardless of your age, you should get these documents completed and notarized. You never know when the inevitable will happen, and you will wish, or at least your family will wish you had taken the time to complete these documents.
Absolutely. And following up on our conversation about the Fab Lab, I met with a client this week, and they reminded me that their whole family was using the Warner Robins Firestarter Fab Lab, which I haven't talked about in years. I haven't had anyone mention it in a while, and her son is going there to build things every night. They offer classes in woodworking, welding, laser engraving, CNC routing, and Adobe Photoshop and Illustrator. To visit the website, just type Firestarter Fab Lab Warner Robins. Here's an example of what they offer. Woodworking 101. The cost is $200 unless you are a Houston County Board of Education employee or active duty military. Then the cost is only $150. The class I looked at was 7 weeks long, and the classes meet 1 night a week, 3 hours per class. I believe once you take some courses, you can use the shop any way you wish. Might be a fun way to start a hobby or a sideline business. And this week, the Georgia Senate passed a bill banning cell phones at public elementary and middle schools effective July 2026 if signed into law. The Distraction-Free Education Act aims to eliminate cell phone use by students in grades K through 8 during school hours, and it's about time.
Hallelujah.
It is about time. They should add high school to that list as well. And you can use them after the bell rings at 3:15, but in between, shouldn't use them.
You're there for one purpose, to study.
Right. And we didn't have them. We
No.
got by
Right.
okay.
Right.
Also in the news, Moody's downgraded, I'm sure everybody's heard of this one, Moody's downgraded the U.S. government's long-term credit rating from AAA to AA1, citing a decade-long rise in fiscal deficits, mounting debt concerns, and rising interest costs that have weakened the nation's credit profile relative to other top-rated sovereign nations. With this action, the U.S. has now lost its perfect credit rating from all three major credit rating agencies, Standard & Poor's in 2011, Fitch Ratings in 2023, and now Moody's in 2025. Despite the downgrade, Moody's revised the U.S. outlook from negative to stable, reflecting confidence in the strength of the U.S. institutions and resilience of the economy. While long-term fiscal pressures remain, the move to a stable outlook suggests Moody's believes near-term risks are now appropriately reflected in the current rating. Moody's is projecting federal debt to increase from 98% of GDP in 2024 to 134% of GDP in 2035. Interest payments on government debt have become the second largest line item on the budget.
That's insane.
It's kind of disturbing.
And getting worse.
Yep. While the downgrade may appear negative at first glance, the shift to a stable outlook reaffirms the underlying strength of the U.S. credit profile. For investors, this action represents a reset in expectations rather than a loss of confidence, highlighting the need for long-term fiscal reform.
Yeah, we need it. And I would like to see a standardized budget process where we don't run deficits every year. I don't subscribe to the kick it down the road policy politicians have had for the last decade or two, maybe longer. Our kids and grandkids are going to have a real mess to deal with if we don't start being a little more fiscally responsible.
Agreed. So because this show is about your money, what does the Moody's downgrade of U.S. credit rating mean for your money? The debt downgrade put immediate pressure on bond prices, sending yields higher on Monday morning and throughout the week. The 30-year U.S. bond yield traded above 5%, and the 10-year yield topped 4.5%, hitting key levels at a time when the economy is already showing a sign of strain from unfolding tariff policies. Bond prices and yields move inversely. Treasury bonds influence rates for a wide range of consumer loans like 30-year fixed mortgages, and to some extent also affect products including auto loans and credit cards, so avoiding the impact on consumers is going to be hard to do. As we previously said, the rate cut cited the increased burden of the federal government's budget deficit. Republicans' attempts to make President Donald Trump's 2017 tax cuts permanent as part of the reconciliation package threatened to increase the federal debt by trillions of dollars. As a nation, when our credit rating goes down, the expectation is that the cost of borrowing will increase. The same as if your own credit score fell, you would expect to have higher borrowing costs. And Americans struggling to keep up with sky-high interest rates aren't likely to get much relief anytime soon amid Moody's downgrade. Economic uncertainty, especially regarding tariff policy, has the Fed and a lot of businesses on hold.
Yep. Atlanta Fed President Raphael Bostic said Monday that he now sees only one rate cut this year as the central bank tries to balance inflationary pressures with worries of a potential recession. Fed Chair Jerome Powell also recently noted that tariffs may slow growth and boost inflation. making it harder to lower the Fed's benchmark rate as previously expected. Simply put, the downgrade could translate to higher interest rates on consumer loans of all types. Since mortgage rates are largely tied to Treasury yields and the economy, 30-year mortgages are going to be most closely correlated, and longer-term rates are already moving higher. The average rate for a 30-year fixed-rate mortgage was 7.02% as of May 21st, which was up 0.1% from the week prior. Credit card rates tend to mirror Fed actions, so higher for longer would keep the average credit card rate around 20% for the rest of this year.
Right.
If you have credit card debt, you have got to pay it off.
That's right.
You're just throwing money out the window, paying those minimum payments every month. I just can't. I can't take it.
Yep. And because of this, Sell America is back as Moody pushes 30-year yields to 5%. Longer-dated Treasury yields rose to the psychological 5% level, and the S&P 500 index futures slid with a dollar after the downgrade of the U.S. credit score by Moody's. Moody's blamed successive presidents and congressional lawmakers for ballooning budget deficits it said showed little signs of narrowing. The downgraded rating reinforces Wall Street's growing worries over the U.S. sovereign bond market as Capitol Hill debates even more unfunded tax cuts, and the economy looks to slow as President Donald Trump upends long-established commercial partnerships and renegotiates trade deals.
A Treasury downgrade is not surprising given the unrelenting and unfunded fiscal spending we're seeing in D.C., which may accelerate even more, as Randy was just saying earlier. And if the spending is going to continue to increase, that means the amount of service to service the debt will also climb. And at some point, you could start to see large investors like institutional and sovereign investors gradually swapping their treasuries for other safe haven assets. While rising yields typically boost a currency, the debt worries may add to skepticism over the dollar. A Bloomberg index of the U.S. dollar is already close to its April lows, and sentiment among options traders is the most negative in 5 years. Higher yields will add to the government's net interest cost and deficits. Over the longer run, the erosion of the safe haven status of treasuries has implications for the dollar and foreign demand for treasuries and other U.S. assets.
Moody's downgrade of the U.S. isn't a game changer for American assets. It doesn't completely undermine U.S. treasuries given the depth and breadth of the market, but the underlying theme supporting diversification away from America remains intact. European Central Bank President Christine Lagarde said in an interview that the dollar's recent decline against the euro is counterintuitive but reflects the uncertainty and loss of confidence in U.S. policies among certain segments of the financial markets. Rising Treasury yields would also complicate the government's ability to cut back by running up its interest payments, while also threatening to weaken the economy by forcing up rates on loans such as mortgages and credit cards. Scott Bessent, our U.S. Treasury Secretary, downplayed concern over the U.S.'s government debt and the inflationary impact of tariffs, saying the Trump administration is determined to lower federal spending and grow the economy. Asked about the Moody's rating downgrade of the country's credit rating, Bessent said, Moody's is a lagging indicator, and he does not mean that as a slap against Moody's. It's like all credit reporting agencies. It's a rear-looking indicator. Moody's move was anticipated by many, given it came when the federal budget deficit is running near $2 trillion a year, or more than 6% of GDP. The U.S. government is also on track to surpass record debt levels set after World War II, reaching 107% of GDP by 2029.
An analyst at Barclays said in a report that they did not expect Moody's downgrade to change votes in Congress, trigger forced selling of treasuries, or have much impact on the money markets. Supporting that notion, Barclays noted that treasuries have often rallied after similar actions in the past.
So, right, credit downgrades of the U.S. government have lost political significance after S&P downgraded the U.S. in 2011, and there were limited, if any, repercussions. The question is what the path to those yields is going back down. Time will tell.
Yep. All right, switching gears, and we've talked about this loosely a lot on the show, a death sentence diagnosis and the wrenching realities of life insurance. Accelerated death benefits are common in life insurance, allowing the terminally ill to cash in on coverage. Insurers sometimes reject claims due to policy restrictions, capped life expectancy, or disputes over medical assessments. Policyholders may be unaware of their right to claim benefits, leading to potential lawsuits and settlements. Jay Taylor thought it was just a bad case of the flu. An ambulance, hospital stay, and slew of blood tests later, the 63-year-old grandfather learned the devastating truth: he had leukemia. He quickly dug out his life insurance documents from the drawer where they had sat for more than 2 decades. He says one of the first things you think about when a doctor says you have incurable cancer is, how can I protect my family? His insurance seemed to offer the answer. The 2 Massachusetts mutual life insurance policies offered an accelerated death benefit, an option for terminally ill people to cash in part of their coverage while they're still alive. As Taylor came to find out, having an accelerated death benefit is one thing, but actually getting a payout of that accelerated death benefit is a lot tougher. Terminally ill people potentially face a long list of policy restrictions or exceptions. The fate of 6-figure lump sum payments often rests on the judgments of how sick the policyholder actually is. Medical advances are making it harder for doctors to hand out such death sentences with the certainty insurers usually require, as targeted drugs and immunotherapies transform the outlook for many types of cancer. Accelerated death benefits, also known as living benefits, are an extremely common feature of life insurance policies offered by 85% of insurers.
The benefit, which came about in the 1980s during the AIDS epidemic and is likely to be used more widely as the baby boomer generation ages, is pitched as helping provide financial peace of mind. No coffin, no problem. A true life insurance payout story where death wasn't required, read the headline of one insurance blog post last year. Claims are rejected for medical conditions that occur too soon after a policy was bought, are insufficiently documented, or deemed curable, or most commonly are projected to be unlikely to result in death within the policy's specified time limit, according to plaintiff lawyers. Insurers cap the life expectancy at which an accelerated death benefit is payable, something which is required by state regulations. The limit ranges from 6 months to 2 years, depending on the policy. Colin Bancroft, a wastewater treatment operator for King County, Washington, was diagnosed with stage 4 leukemia at age 61 in 2017. His doctor estimated his life expectancy at 24 months, short enough for Bancroft to claim an accelerated death benefit under his employer's life insurance. The insurer that issued the policy, Minnesota Life Insurance, rejected the claim. It said Bancroft's doctor had relied on an outdated medical study that didn't reflect treatments he was receiving. Bancroft sued, and the insurer later paid the benefit after new information about his life insurance emerged in court. A federal court and an appeals court, however, upheld the initial decision to reject the claim. Bancroft died in 2021 at age 64, 4 years after his initial diagnosis, records show.
All right. That's terrible. The insurance companies made the client's life even more difficult in the short time they had remaining. Consumer advocates say that disputes over accelerated death benefit claims are often settled on confidential terms, according to one lawyer who said that these deals can leave policyholders' families worse off. And a lot of times, to be sneaky, they'll offer you $10,000 to $20,000, hoping you'll take that, and then the death benefit will go to nothing, go to zero. So you need to read the fine print. Taylor said the prospect of an early benefit was exactly what he needed. His rapidly progressing illness left him unable to do his job as a lawyer. The benefit represented a much-needed source of cash to help pay regular bills as well as pursue advanced medical treatments. His insurer, however, repeatedly rejected his claims for $250,000 accelerated death benefit on grounds that his life expectancy was longer than a year, limited by his policy. Days before Christmas in 2023, MassMutual offered $90,000 to resolve his complaint if he agreed to cancel his policy, sacrificing the $1.55 million, which was the insured amount that would otherwise be paid to his schoolteacher wife, Lisa, after his death. He rejected that in an email to the insurer, calling it insulting and unfair. In December, after Taylor's doctor had signed a terminal illness statement saying the medical complications made his prognosis poor, MassMutual increased the settlement offer to $400,000, but still had the condition that he had to cancel his policies. Again, Taylor said no. A deal was finally struck earlier this year. Taylor wouldn't discuss the settlement, which MassMutual insisted was made on a confidential basis. A spokeswoman for the insurer, which received Taylor's permission to discuss this case, said that the life insurance policies remain in effect after the pact. The Mass Mutual spokeswoman added that the insurer never received the doctor's certification that Taylor's medical condition met the policy's definition of terminal illness. As such, it was not appropriate for Mass Mutual to fulfill the claim request. For an insurance company, these claims are not. These are a game of numbers. But for a family in their position, is the difference between financial survival and catastrophe.
So I bought a 10-year, $1 million policy on Randy when he was 10 years from retiring from the base, just to make sure that we would be okay regardless of what happened. Plus, I had quit my job and started my own business, so didn't have a steady income, and we had 2 teenagers. And so I wanted to make sure that if something happened to him, he could have been hit by a car or anything, and I could get the kids through college, I could pay off the house, I could take care of everything. So that policy gave me peace of mind, and it really wasn't that expensive, and it was totally worth it.
But that one didn't have any sort of accelerated.
No,
zero.
that was just a term
Just a
policy.
traditional-
Term, 10-pay term.
Got it.
Yep.
Excuse me. So, I mean, as you guys know, I've dealt a lot with accelerated benefit policies in my time doing this, and but not a whole lot in the terminally ill variety of the accelerated benefit, which is what we're talking about here. The verbiage in the contracts, it never gave me great confidence that they would really do a whole lot for the client, and these stories are proof of that. I mean, very, very loose verbiage that says, if your life expectancy is between 6 months and 12 months, as determined by your doctor, only then will we pay a bit, and it just seemed very loose and like, okay, I don't, there's some very strict terms that have to happen for this to even help me.
That's right. And with the medical advancements, I do understand why the insurance companies are saying what they're saying, but
Pushing back, yeah.
but the terms, when you get these insurance policies, you really need to know what they're saying
For sure.
up front before you sign on the dotted line.
And so that said, I didn't ever deal with the terminally ill accelerated benefits. I didn't fool with those much. But what we've talked about on this show is doing life insurance policies that have accelerated benefits for long-term care expenses. In fact, we were just able to help one of Sherry's clients with one of these. Sherry, I think the topic of long-term care came up in your meeting with this gentleman, and you uncovered the fact that he had an old whole life insurance policy with some cash value in it, if I recall. And
Yes.
after the meeting, you told me his situation and that he wanted long-term care coverage, but he didn't necessarily want to pay the exorbitant high premiums that you have to pay now to get long-term care coverage. And so his life insurance policy was about 30 years old, and it had $82,000, give or take, of cash value in it, and also a death benefit of about $140,000. And so we ran some numbers for him, and it turned out we were able to get him a significantly improved life insurance policy with accelerated benefits for long-term care built in. Of course, he had to go through the application process, underwriting, medical records, etc., all that fun stuff. But once he got through all that and got approved, he ended up with a $250,000 policy with 100% of that death benefit available for long-term care expenses, should they arise in his future. He's able to get that just by transferring the cash value from his old policy to the new one.
That's fantastic.
It's great, and he was a good candidate. He was healthy.
And the products that are out today are often a lot better than they were,
20 years ago.
20 years ago. So
sure.
Oh, yeah.
yeah. So
This
taking that
wouldn't-
cash
couldn't have-
value,
You couldn't have done this 20 years
taking
ago.
that cash value, it just upgraded what he had.
Absolutely. And for him in particular, he didn't need this old policy. He's a widower.
Yep.
He wasn't relying on it by any stretch of the imagination, leaving the money to anybody. So if in his situation, we were able to leverage it, get him in a much better position to take care of himself with the accelerated benefit for long-term care should that arise. And at the end of the day, it still is a life insurance policy that's much improved on coverage
Yep.
over what he had previously.
And no money out of pocket, which is
So-
the
Zero
which
money
is
out of
which is
pocket.
the
That's the
best
beauty.
thing. It's the beauty of it.
So tell people what they should look for if they have an old life insurance policy. What should they look for, and who should call you to see if they can do this same exact thing?
So a couple things. One, it's important that you're healthy because you'd have to be re-underwritten, right, for a
Yes.
new policy. So if you have something terminal already or some history of bad health, it's probably going to be hard to get something like this for you. So first of all, good health. This gentleman was in his early mid-60s, very healthy. It was no problem to underwrite him. So that's probably the top thing. Secondly is the cash value from your old policy cannot be an asset that you're relying on to be there for retirement or that you plan to use for anything
Good point.
necessarily.
Yep, good point.
Because that cash value is mostly what is used to buy the new policy. And so anybody we've done this for in the past, we've made it clear with them, hey, this cash value, we might as well act as though it's not even there. And they say, that's fine. I pretty much forgot about it anyway. It's this old
Don't need it.
Don't need it. Don't plan on needing it. And so that's really the second most important thing is, okay, if this X number of dollars in this old policy is just more or less out of sight, out of mind, then let's use it and potentially leverage it to get you into a better position. But the biggest thing is if you don't already have long-term care insurance and you've never gotten it, and now you're all of a sudden in your late 50s, 60s, 70s, wherever you may be, it's cost prohibitive, as Sherry, as you know, to get long-term care insurance as a standalone policy. And you still may never need it because you still may never end up in a nursing home.
Right.
And I would say if you're unsure, just give you a call.
Yeah, for
call
sure.
Jonathan,
you can email
seriously.
me or you can email Randy. If you have a question about it, we would certainly look at your old policy. And we've looked at policies before where it didn't make sense. And we told people, hey, look, stay in the one you're in.
Yeah.
Because it's growing better than the new one would, or your benefits better for whatever reason.
Because we have to act in the best interest of our clients.
Yeah, and that,
prospects.
And that's
we
one
have
thing,
to be honest with them.
I was going to say the same thing. We are not
Trying to sell stuff.
We don't push products just to
Right.
make a commission. If it doesn't fit for you, it's not a good fit.
We tell you.
We'll flat out tell you.
Randy, you had a lifelong friend that came to you in the past week or two and needed help.
He just retired from FedEx. He had two pension options there that he could take, and he'd been for years saying, when I retire, I'm going to take this money, I'm going to roll it into an annuity with you, and then so the time came. So he sent me the FedEx paperwork. I looked at it, and I know his background. I know what he needs and
his spending habits,
everything, and I walked it down the hall without even saying a word. I said, Jonathan, I want you to take a look at it, and then let's see if we come to the same conclusion. He looked at it, and about 15 minutes later, we got back together, and we did. We came to the same conclusion that he needed to stay with the FedEx package because it's going to offer a better cash payout for him, effective immediately, and so that's what we did. So yes. It would have been great to have him as a client, but it was not in his best interest. And that is the fiduciary's responsibility to make sure that we're acting in the client's best interest.
There you go. So, not to toot our horn, but we do turn away people who are looking for help. And he would have been an easy person to, quote, take advantage of. He's a lifelong friend.
Yes.
He trusted you.
Yes.
But, and so we said, no, man, stay with what you're doing.
Do the right thing.
That's right.
All righty.
So anyway, email me, Jonathan, at rfmoney.com if you have an old policy and you'd like us to assess where you are.
All right.
You've been listening to Your Money, produced by Lifespan Wealth Management with your hosts, Sherry Goss, Randy Goss, and me, Jonathan Eisner. If you'd like to contribute to the show, you can email Randy at rfmoney.com with a question or topic that you'd like us to cover in a future broadcast. Our number is 478-922-8100. We have offices in Macon and Warner Robins for your convenience.
And you can find out more about us by visiting our website, retirerelax.com. Lifespan Wealth Management has been serving the Middle Georgia area for over 30 years, helping people like you achieve their investment and retirement goals. And if you're in need of a financial advisor, please contact our office at 478-922-8100.
We also offer seminars to the community at no cost. So if you are in need of a guest speaker for your church or civic organization, give us a call and together we can decide what topics you would like us to present to your group.
Again, our contact number is 478-922-8100. Now back to the show.
So this next article, when I start talking, you're going to wonder why I'm talking about this, but just hang in there because there is a reason. International Paper is on a quest to build a better cardboard box. When a recruiter approached Andy Silvernail about joining International Paper to turn around the 127-year-old company, he initially said no. Silvernail grew up in the shadows of a paper mill in Buckport, Maine, that produced the paper on which Time magazine was printed. The mill closed in 2014, devastating his hometown. Silvernail told the recruiter that he didn't want to lead a declining commodity business that could only win as the cheaper producer. Andy, the recruiter said, "You're wrong. It's not a paper business. It's a packaging business, and it's misunderstood. Silvernail, who had retired at 50 after a lucrative run as chief executive of an industrial conglomerate, was dabbling in private equity at KKR and looking for a business that needed to be transformed in a big way. Now 54, he said he wouldn't have taken the top job at International Paper if he thought it would be easy. He said there's some possibility that they're not going to succeed, and I like that. His first year on the job seemed promising. Wall Street cheered his plan to narrow the company's focus to corrugated cardboard packaging, hire more salespeople, close money-losing mills, and revamp its network of box plants. International Paper shares surged more than 70% from when his hire was announced.
Silvernail got his first taste of trouble when President Trump's tariff plan stoked fears that economic activity would tank. International Paper does not sell many boxes across borders, yet its shares tumbled. Cardboard boxes have become a reliable economic indicator.
I find that so interesting.
Very interesting.
It makes perfect sense, though.
It does.
It does. So, cardboard box is a good indicator of economic strength. Yeah, the better the economy, the more that corrugated packaging is consumed. Not just for Amazon deliveries, but to move everything from factory parts to fruits and vegetables all over the country. If we see meaningful weakness from here, it's going to stretch us, Silvernail told investors last month. There's no doubt about it. International Paper had just reported disappointing quarterly results, and the Commerce Department had said that the U.S. gross domestic product contracted for the first quarter. Nonetheless, Silvernail kept the company's forecast for North American profit to double by 2027. Besides turning around an old economy behemoth with tens of thousands of employees and hundreds of factories, International Paper is also folding in DS Smith, a European company it acquired in January for $7.2 billion. And it is selling off volatile fluff pulp business, which makes exorbitant material for diapers. Meanwhile, the trade war has the box industry tearing up growth forecasts. International Paper was founded in 1898 with 17 pulp and paper mills in the Northeast combined. From there, it branched out from newsprint to other types of paper and corrugated packaging. Invented in England in the 1850s to maintain the shape of the era's tall hats, another interesting fact I thought, and became one of the most durable brands in American business. By 2021, International Paper had spun off the last of its paper business to focus on boxes solely. It was still acting like a paper company, though. Eager to ensure that enough volume moved through its box plants to keep its mills running, it locked in years-long deals with national accounts at cheap rates.
When demand surged during the pandemic e-commerce boom, the company ran into operational problems, exacerbated by years of deferred maintenance. It had to satisfy low-margin contracts at the expense of more profitable regional and local customers, including farmers, meat packers, and manufacturers. Its profit margins and shares slumped. Investors wondered how the company would pay its dividend after shedding its pulp business in Siberia, which was a cash cow.
Well, Silvernail, who was a linebacker at Dartmouth College, has a style that is more like that of a ball coach than a bean counter. He earned his reputation as a management whiz when he rose through the ranks at Danaher. He preaches an 80-20 philosophy, focusing on a small number of customers that account for the bulk of the business and allocating resources accordingly. Silvernail's office in Memphis, Tennessee is decorated with a photo of a mill given to him by a childhood friend who went back to work for the International Paper after high school. The job of his friend and nearly 700 others were eliminated a week later when Silvernail decided to close the mill that was losing money. That was a brutal decision, he said, except economically. If it can't stand on its own, it has to be closed.
Yep. The savings will be invested into other mills and put toward building new box plants and hiring salespeople. Silvernail wants salespeople in the back of delivery trucks talking to drivers and meeting with clients, with designers in tow, to come up with custom packaging. The idea is for International Paper to make what it can sell, not to try to sell what it makes, as it has been doing. This is such a cool story.
It's so true, and it makes so much sense.
Now, Sherry, at the beginning of this, you said, stick with this. You don't know why I'm...
There's a rhyme and a reason.
There's a rhyme and a reason. So I like this story because small businesses need to understand that, if you're not making money, you can't just keep hanging on just because it might turn around. You have to understand when you've got to cut bait, basically.
Yeah.
And that's what I get out of this story. And this guy gets it.
Mm-hmm.
He had to fire his friend.
He had to fire his friend. I mean, that has got to be the most gut-wrenching thing you have to do.
Yeah.
And along with the other 700 people, letting people go hurts. I get it. But that is one thing I've learned in business too. Is like, you got bad employees that won't listen, won't do the job. They show up late. You can't just keep hanging on to them. You've got to let them go because the other employees are at risk because of that.
Yep.
So,
And they'll be attracted to behave the same.
that's right.
That's our son runs an automotive shop, and that's a great example
Yep.
of that.
Yep. It sure is. Anyway,
Alrighty.
let's shift on to scams, which we feel like we always have to talk about them. But Meta battles an epidemic of scams as criminals flood Instagram and Facebook. We will start this off with the phrase, if it seems too good to be true, it probably is. Fake puppies and phony offers of mouth-watering bargains are often created by overseas crime networks. And these scams are flooding the Meta channels, and some employees of Meta say the company is reluctant to impede the advertising juggernaut. In other words, they're making money selling advertising and don't want to impede that. For example, for almost 2 years, Edgar Guzman has been getting calls from irate customers who respond to his ads on Instagram and Facebook, or at least they thought they were his ads. Guzman's company, called Half Off Wholesale, offers home improvement supplies and garden equipment in bulk out of a suburban Atlanta wholesale warehouse. The ads offer steep discounts that are extremely enticing to bargain hunters. $29 for a pallet of power tools and mixed boxes of returned Amazon merchandise with a starting bid of just $1. But when people send their payments, the products never arrive. And when they call Guzman to complain, he has to deliver the bad news that they've been swindled.
This when I was reading over this article earlier this week,
Yeah.
this reminded me of the incident I brought up about 6 weeks ago on our show, where my wife,
Oh, yeah.
my dear wife, thought this ad on Facebook was true. She was
Was
truly
that the
going to
Yeti
get
cooler?
a Yeti cooler for free and only pay $15 for shipping. And of course, they swiped our credit card. No cooler ever showed up.
I have a client just this week went through this. She believed it too, and she ordered a bunch of cheap stuff and then realized how bad it was and had to cancel her credit card and shut it down.
Yep, that's everything
It
we
looks
went
so
through.
real.
It does.
And with AI, it's getting worse.
It is.
You got to be careful.
And so I didn't know until I read this article this week, and we're about to talk about this. I'm a little bit more irritated about it now because Facebook doesn't actually want to do anything about
Yeah.
it.
Now that you learned that they're
They-
happy with the money
Yeah,
they're making.
They're making the money from the people putting the scams on there, so
Right.
they're like, whatever.
It's just Jonathan's money.
It's just Jonathan getting duped into not getting a Yeti cooler. So, all right. So to make matters worse, the company for Guzman gets slapped with bad online reviews, even though they don't actually conduct online sales.
Oh, frustrating.
Their experience is not one-off, and Meta and Facebook are doing very little to stop the problem. According to regulators, Meta Platforms, which is the parent company of Facebook and Instagram, is increasingly a cornerstone of the internet fraud economy. The company accounted for nearly half of all reported scams on Zelle for JP Morgan Chase between 2023 and 2024. British and Australian regulators have found similar levels of fraud originating on Meta's platforms. An internal analysis from 2022 described in company documents likewise found that 70% of newly active advertisers on the platform are promoting scams, eliciting goods, or low-quality products. Let that sink in for a second. 70% of newly active advertisers on the platform are promoting scams or selling you something that is not what you think it is.
It used to be that people would just try to up their likes or their positive reviews just so you could get buys. Now they're just being outright fraudulent about everything.
And
It's
Facebook's like, hey, as long as you keep paying us, you
we'll
can keep doing it.
Yeah, keep doing it.
So here's a problem I've got to add to this that I did not put in the story. I have a client years ago, and he had dementia, and his daughter would come and check on him 3 times a week and make sure he was eating, make sure he took his medication, make sure he's doing everything right. Well, she shows up one day, and he's crying because his checkbook is overdrawn. And what it is he was getting all of these. This is back in the day when you got a paper mail thing saying that you've won something,
Oh, yeah.
but they want you to mail in a check so you can get that 500 million or 1,000 or whatever dollar amount they're saying. and he had spent $150,000
Oh my gosh.
out of his checking account, believing he was going to get this money, and he would forget about the last one he just did, and they farmed his information out to everybody. Once he got scammed, they wanted everyone to know that they could scam this dude, and he was being scammed by tons of different entities.
Well, it's only gotten worse with AI and the internet. My grandparents, Goss, they were in the same thing, and it was just by mail. I mean, we would go up there, and there'd be checks and all the new mail that came in. I mean, there were always hundreds of these things. You've won. Send us this.
Yes,
It was terrible.
it is.
And that
terrible.
was in the I can't remember what year they died. It was 20 years ago, I guess.
But it's worse now that it's online.
Right.
In your Facebook. Anyways, in Guzman's case, a search of Meta's ad library this spring showed that more than 4,400 different ads listing the address of his business have run on Meta's platforms over the last year. Guzman's actual business was responsible for 15 of them. Account information for the scam pages shows they were run out of China, Sri Lanka, Vietnam, and the Philippines, but they also stole pictures of Half Off's warehouse and list its address. With more than 3 billion daily users on Meta's platform, fraud is hardly a new phenomenon for the company. But fed by the rise of cryptocurrencies, generative AI, and vast overseas crime networks based out of Southeast Asia, the immensity of Meta's scam problem is growing and has been regularly flagged by employees over the past several years. Current and former employees say Meta is reluctant to add impediments for ad buying clients who drove a 22% increase in its advertising business last year
There you go, right there.
to over $160 billion with a B, even after users demonstrate a history of scamming.
Just very frustrating. Adding to the problem is Marketplace, and I can relate to this one. It's online, which is Facebook's online secondhand market that in less than a decade since its launch has surpassed Craigslist to become the internet's most heavily used website for free classified ads. Its peer-to-peer model also makes Marketplace a popular hunting ground for scammers. One of the most common scams seen by banks involves the sale of pets, despite Meta's rules banning peer-to-peer sales or trade of live animals outside of narrow context. A recent search for puppies over several days yielded thousands of ads, most stating no affiliation with a known dog breeder or rescue organization as Meta's rules require. And there were a lot of other red flags too. Many of the results displayed common hallmarks of scams, including stolen photos of specific pets and ads from sellers supposedly, quote, near me, who were actually operating out of Cameroon.
And,
Oh my
and it's not
gosh.
just pets. If you're looking for autos, you
Yep.
go onto the Marketplace or tools. You'll see
Oh.
the same thing. You'll see the exact same photos from 20 different people. So and if the price seems too good to be true, as we
It
started
probably
out this
is.
article with, it probably is
Fake.
fake.
So you have heard us discuss scams on this show for years, and we always caution you to be vigilant to any advertisement, email, or pop-up, or even websites that you are unfamiliar with. The reason is that, especially now with AI, scammers are able to mimic websites with such accuracy it is almost impossible to tell the difference. Scammers are always creating new and improved lookalike websites to trick you out of your personal information and money. These websites may have a very similar URL or look identical to the real website you're searching for, which means it can be hard to identify. Recent examples of this kind of scam include fake streaming service activation prompts, DMV imposters, and fake postal service websites. Even BBB.org has been imitated, where scammers are tried to look into BBB to collect information fraudulently.
Yep. So what do? How do you identify the real site from the fake site? Look closely at the domain name. One way fake websites trick people is by using domain name that is extremely close to the real business or organization's domain name. Upon closer examination, you might notice that the two letters are swapped out or just slightly misspelled. If you find a spelling error in the domain name, you're not on the official site, and it's best to close the tab. Watch out for tricky subdomains. Sometimes attackers hope you'll confuse a subdomain with a real domain name of their website. For example, a scammer might use a domain name netflix.com.movies.com, hoping you won't notice the real domain is actually movies.com. Be careful with links in emails too. Phishing scams are extremely common. A scammer might send you an email that looks like it comes from a reputable business in hopes that you will click on links without a second thought. Always hover over the link in the unsolicited email, and even in the emails that come from a brand or business or a person you might think that you know. If the link doesn't match the blue text, or if it is a short link and you can't tell where it leads, don't click on it. If you do, you may end up with a lookalike website where your personal information could be compromised, and probably will be.
Check the quality of the visuals on the site. Low quality images and poor web design can be all warning signs of a fake website. These could be indicators that images were copied from the real site. Pay attention to the contact and shopping policies. Legitimate online stores should provide you with a physical address and working phone number in the contact section. If those elements are missing, it's best to take your business elsewhere. Do a search for reviews and potential scams. Anyways, just be careful out there. Alrighty. So meet the stealthy wealthy who make their money the boring way. Derek Olson grew up dreaming about the thrill of running his own business. Decades later, that dream came true and made him wealthy, just not exactly in the way he expected. Olson has made a fortune making machines that rip up flooring like carpeting in elementary schools. Olson says, "This is how great it is. The average elementary school in the United States has 7 miles of carpet, and children are disgusting." Olson is chief executive of National Flooring Equipment and a father of 2. So, elementary schools basically need their floors redone every other summer. It's this niche industry that no one knows about and everybody needs. Finance and Silicon Valley offer glamorous, high-profile paths that can lead to significant wealth, but a vast universe of our traditional routes focused on providing goods and services has become increasingly central to the accumulation of significant, if less obvious, wealth in the United States. Olson's annual income running his flooring equipment company puts him in the top 1% of earners in the United States, or people who, as of 2022, made at least $550,000, excluding capital gains. He expects Minnesota-based National to bring in roughly $50 million in revenue this year, after recently buying an Australian manufacturer. His family's luxuries include 2 Land Rovers, private school for the kids, and a month-long European summer vacation. Behind a paycheck, the largest source of income for the 1% highest earners in the U.S. isn't being a partner at an investment bank or launching a 1 in a million tech startup. It is owning a medium-sized regional business. Many of them are distractingly boring and extremely lucrative, like auto dealerships, beverage distributors, grocery stores, dental practices, and law firms, according to Zwick.
All right. Their analysis of tax data from 2000 through 2022 suggests the importance of such business ownership to the U.S. economy has grown. The share of income and that ownership generates has increased to 34.9% in 2022 from 30.3% in 2014 for the top 1% earners. It has increased even more for the topmost levels. The top 0.1% highest earners saw 43.1% of their income from such business ownership in 2022 compared to 37.3% in 2014. That's too many percentages.
Too many
here.
numbers.
Yeah. Anyway, they're doing well. The Zidwick attribute the growth to this group to tax cuts in recent decades for such business owners and now interest rates that have boosted companies' valuations. The number of such business owners worth $10 million or more adjusted for inflation has more than doubled since 2001 to 1.6 million as of 2022. Zidwick studies what the Internal Revenue Service calls S corporations and partnerships, where the profits and losses of the business flow through to the owners or partners, and the business itself does not pay taxes. The typical medium-sized business they studied has annual sales of $20 million and 100 employees.
Here's another good example, and this is why I was saying earlier that I love these stories after we talked about the International Paper guy. David McNeil, 66, founder of car accessories maker WeatherTech, made his fortune on car floor mats.
This is so cool.
Yeah, I love this.
He worked as a tool and die maker, dropped out of college, and sold luxury cars. He rented a car on a trip to Scotland in 1989 and immediately noticed its floor mats. Thick and with a border preventing water and mud from running off, the rubber mats were superior to anything he had seen in the U.S. McNeil called the English manufacturer when he went back home in Chicago and eventually worked out a deal to buy a 20-foot shipping container of the black mats to sell in the U.S., taking out a second mortgage on his home to do it. By the end of 1991, I made $40,000. By the end of 1992, I made $160,000. By the end of 1993, I made $400,000, recalled McNeil,
I love it.
who by that time was married and a father. While all this was going on, if you called my 800 number at 3 o'clock in the morning, you know who answered it? It was me. The business McNeil started from his garage 35 years ago now employs 1,800 people
That's wild.
in Bolingbrook, Illinois, and makes nearly its entire range of car accessories and other products in the U.S., which is nice. No tariff problems. McNeil expects his company to bring in about $800 million in revenue this year.
So Larry Fleming, 80, a Wendy's franchisee, made his money in burgers and then beer. The tipping point for focusing on beverages came when the Muskogee, Oklahoma beer distributor he had bought in 1977 started out-earning the fast food restaurants he had bought a little earlier. Fleming sold his fast food business in 2017. It numbered 43 restaurants by then. That's a lot. For more than $50 million, including the real estate. Fleming's beverage distribution company, LDF Sales and Distributing, sells Coors, Miller, and other products to roughly the eastern halves of Oklahoma and Kansas. He has grown LDF partly by buying a distribution rights and other distributors. The company has about 64% market share in Oklahoma, and annual sales are approaching $250 million. He says anytime 2 out of 3 beers going out of a restaurant or grocery store are ours, that's a good thing.
Yeah, right.
There's a large market share.
That's right. You know what? I'm going to add to this. I was watching a YouTube video the other day on.
Really?
Yeah, I was. And guess what it was on?
I don't know.
Cars. And
Shocker.
shocker. But Ken Diggett, if anybody that's a car guy knows, or specialty cars knows Ken Diggett. And this guy, he's only 45 years old. And he builds some of the most.
I actually watched the first minute of that.
Yeah, and he builds some of the most beautiful custom cars you've ever seen. At 45, he has, I can't remember the number of employees, but he made a statement in that show that I had to back it up and hear it 2 or 3 times. But he has $80 million backlog of orders.
Of orders.
And it's a 7-year, it's going to take him 7 years to fulfill that. And this order's coming in every day. And I love, his wife's name is Charity. Okay. So all of his accessories, they go to his favorite charity. So
Cool.
I love that.
There you go.
Anyway,
So when I was 19, I had a roommate in college, and I visited his family. They lived in Gwinnett County, Georgia.
Yeah.
Snellville, to be exact. And I didn't know anything about his family at the time. I knew him very well. We were roommates. We were very good friends. And I show up at his house, and he's got this massive, very nice house in Snellville, Georgia.
Mm-hmm.
Pool, the kind that has the waterfall flowing into it.
yeah.
A lot of land, a lot of grass, dogs, just this incredible life. And so we get back to Athens, and we get to the apartment. And I say, Bo, what does your dad do? And his dad worked for a company that sold, this was so life-altering for me at 19. He worked for a company that sold the bumpers on the corner of the grocery store aisles so that carts don't hit the freezers and refrigerator door, those sections. The bumpers on the corner of the aisles. This guy worked for a company that did that and had this life.
Well, the guy that,
Wow.
the guy that created those little reflectors you see in every interstate, every road, the ones that you drive like a bump bump. He makes a penny a piece.
Oh my goodness!
How many of those are sold worldwide?
Right.
He has
It's
no
the
worries.
things you would never
He has
think
no
of.
worries. Anyway, moving on. Let's flip over to page 26.
All right. So,
And I'm going to start here. And this is one that it's a topic that Sherry just loves. It can be challenging to put together money for a wedding, but with a good budgeting and smart strategies, you can have a real day to remember. According to data from The Knot, the average wedding runs about $35,000.
it's just stupid.
Yeah.
Just stupid.
And if
You're
you plan
getting
to
fired up, Randy.
I know. And if you're planning to get married at some point in your future, we might suggest creating a dedicated wedding day fund now. Make regular deposits and get compound interest to help you reach your goal. And then
Or just go to the JP and pay $75 and get it over with.
and there's another option.
There you go.
And then it's up to you to stay on budget. But before you start visualizing your wedding, think about how elaborate you want it to be. And the way we think about it is how much debt you want to be in on your first day of marriage. And then once you know what you want to spend, then you can create the budget. And that's the important first step. So
our kids came to us because they know we make money and they want a big wedding. And so I said, here's what you're going to get, $2,500.
yeah.
Figure out the rest of it yourself.
Yep. But look, as you move forward with the wedding, use credit with care. You really don't want to enter your first month of marriage with huge credit card bills.
Right.
Set limits and only spend what you can pay off. And credit's a tool. It's not a total solution. You also may want to ask your family what they're willing to support you with. But just remember that if you ask them for money, that they're going to want to probably have a say in the wedding.
Here's the bottom line.
No, hang on, we're out of time. We know people have taken money from their retirement accounts to fund the wedding.
Not a good idea.
And this is, in our opinion, it's not a great decision and one you could regret. First, you probably have to save. You probably saved that money for many years for your retirement, not to spend it on one day. So,
Can I say my bottom line?
Nope, we're out of time. Thanks for listening, everybody.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. If you're looking for an investment advisor, call our office at 478-922-8100 to set up your complimentary consultation. You can learn more about our services by visiting our website at retirerelax.com.
And if you'd like to contribute to the show, you can email me, randy@rfmoney.com, with a question or a topic that you would like for us to cover in a future broadcast. And we look forward to connecting with you next week. Have a great weekend, everyone.
Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.